In August of 1957, William and Daisy Myers prepared to move with their 3 children into a house on Deep Green Lane in Levittown, Pennsylvania. The house was modest. The street was quiet. The community had been built as a symbol of post-war opportunity. New homes, curved roads, schools, lawns, shopping centers, and mortgages that ordinary working families could afford. Then the crowds arrived. The Myers family was the first Black family to buy a home in Levittown. Hundreds of people gathered near the property. A window was broken. Crosses were burned. State police were sent in. Some neighbors defended the family. Others insisted that this new suburb, created for mass homeownership, should remain closed to them. The Conradictine reached far beyond one street. Levittown existed because the federal government had helped make long-term, affordable mortgages possible. Yet the same housing system had developed rules that treated racial integration as a financial risk. It expanded ownership for millions of Americans while restricting who could enter many of the places where the greatest new wealth was being created. That is the central question of this story. How did federal policy turn homeownership from a difficult and uncertain purchase into an American standard? And how did the rules that opened the door for so many families help close it for others? Today, roughly 2/3 of American households own the homes in which they live. A fixed-rate mortgage paid over decades feels like a normal private contract between a buyer and a lender. It is easy to assume that this arrangement emerged naturally from the market. It did not. The modern American mortgage was built through a series of federal decisions made during crisis, war, and post-war expansion. Washington rescued failing home loans, insured private lenders against loss, guaranteed mortgages for veterans, created a national secondary market, standardized property appraisal, and reinforced ownership through the tax system. Federal policy did not act alone. Rising incomes, wartime savings, mass construction, population growth, automobiles, highways, and cheap suburban land all mattered. But without the new federal housing system, the post-war transformation would have been smaller, slower, and financially very different. To understand what changed, we have to begin with a mortgage system that most Americans today would barely recognize. Before the 1930s, buying a house often required a large down payment. Many lenders would finance only about half of the property's value. Loans were commonly short-term, sometimes lasting only a few years. Payments often covered interest without fully paying down the principal. At the end of the term, the borrower faced a large balance that had to be refinanced or paid at once. This was not necessarily reckless in a stable local market. Banks and savings institutions knew their communities. Borrowers expected to renew their loans. Property values were assumed to hold. But the arrangement depended on continuing credit. A family could make every regular payment and still lose the house if the lender refused to renew the mortgage when the final balance came due. Homeownership was therefore not simply a question of earning enough to make a monthly payment. A buyer needed substantial savings, access to a willing local lender, and confidence that credit would still be available years later. The mortgage itself transferred much of the refinancing risk to the homeowner. For many households, renting was therefore not a temporary stage on a predictable path to ownership. It was the practical result of a financing system that demanded capital before it offered security. Building and loan associations did help working families save and borrow, and some employers, relatives, and local networks created alternative routes. Rural ownership followed different patterns. Even so, the national market remained fragmented. The price, term, and availability of a mortgage could depend heavily on the institution across town and the stability of the local deposit base. The old arrangement also limited the building industry. A builder could not confidently produce thousands of houses for buyers who needed thousands of separate, locally negotiated loans. Standardized mass construction required standardized mass finance. The transformation of the house and the transformation of the mortgage would have to occur together. Then the Great Depression broke that system. Property values fell. Banks failed. Unemployment destroyed household income. credit contracted just as millions of borrowers needed to refinance. By 1934, about 40% of urban homeowners were in default on their mortgages. During the decade, millions of families faced foreclosure or the forced loss of their homes. The crisis exposed a basic weakness. The nation had encouraged ownership without creating a stable national system for financing it. When local credit collapsed, a private mortgage problem became a national economic and political emergency. The first federal answer was not to invent the 30-year mortgage. It was to stop the immediate destruction. In 1933, Congress created the Homeowners Loan Corporation. The new agency bought troubled mortgages from lenders and replaced them with government-backed loans on more manageable terms. Instead of a short loan ending in a large balloon payment, borrowers could receive a longer mortgage with regular payments that reduced both interest and principal. Between 1933 and 1936, the corporation refinanced about 1 million delinquent mortgages. That represented roughly 1/5 of the nation's mortgages on non-farm, owner-occupied homes with 1 to 4 units. The program did not save everyone. It foreclosed on borrowers who could not recover. But it demonstrated that the federal government could reorganize housing debt on a national scale. The Homeowners Loan Corporation changed more than payment schedules. It collected information about neighborhoods and property risk. Its residential security maps divided sections of cities into grades, with the lowest-rated areas outlined in red. Race, ethnicity, housing age, income, and perceived neighborhood stability entered those judgments. Those maps later became the most recognizable image of redlining. Their role, however, has to be described carefully. The corporation itself did refinance mortgages in black neighborhoods and made loans to black homeowners. Historians and economists continue to debate how widely its maps were shared with private lenders and how directly the maps changed lending decisions. Some recent research finds that the boundaries had lasting effects on values, ownership, segregation, and opportunity. Other research concludes that the Federal Housing Administration had already developed its own discriminatory system before many of the famous maps were completed. The important point is not that one set of maps single-handedly created housing discrimination. Discrimination existed before the New Deal. Banks, real estate boards, developers, local governments, and homeowners had already built racial barriers into the market. What the federal government did was more consequential. It created national standards for deciding which mortgages and neighborhoods deserve protection. In that process, existing prejudice could be converted into official financial judgment. But rescuing old mortgages was only the beginning. Washington was about to jettison the loan itself. Congress created the Federal Housing Administration in 1934. The agency did not normally lend money directly to a home buyer. Instead, it insured approved mortgages made by private lenders. If a qualified borrower defaulted, the federal insurance protected the lender against much of the loss. That change sounds technical. It transformed the balance of risk. A bank considering a long-term mortgage faced uncertainty. The borrower could lose a job. The property could decline in value. Interest rates could change. A local institution might not want its money tied up for 20 or 30 years. Federal insurance reduced that fear. With the government standing behind an approved loan, lenders could offer longer terms, smaller down payments, fixed payments, and full amortization. A family no longer needed to arrive with half the price of a house in cash. The final payment no longer had to contain a large unpaid balance. Each monthly payment could gradually build ownership. The familiar mortgage payment combined principal and interest into a predictable schedule. That predictability mattered to families. It also mattered to builders. A developer could construct large numbers of houses only if buyers could obtain standardized financing at scale. The Federal Housing Administration, therefore, did more than help individual borrowers. It helped define what a marketable American house should be. Its standards influenced construction, lot layout, street design, utilities, appraisal, and neighborhood planning. Builders had an incentive to follow federal expectations because approved properties were easier to finance. The government was not replacing the private housing market. It was designating the conditions under which the private market could expand. Federal standards brought discipline as well as exclusion. Insured homes had to meet construction and appraisal requirements intended to protect the borrower, the lender, and the insurance fund. Regular amortization reduced the danger of an unpaid balance arriving all at once. Property inspection reduced some forms of poor construction. National rules made mortgages easier to compare and trade. Yet a standard is never merely technical when it decides where capital will go. Rules about street design, land use, property condition, neighborhood stability, and future demand rewarded some forms of development over others. New subdivisions built to federal expectations could receive a financial advantage over older city neighborhoods that officials viewed as declining. The mortgage system therefore influenced not only who bought, but what America built. Another problem remained. Even an insured mortgage could tie up a lender's money for decades. If local banks had to hold every loan until the last payment, the supply of mortgage credit would still depend heavily on local deposits. In 1938, the federal government created the institution that became Fannie Mae. It purchased eligible mortgages from lenders. The lender received cash and could make another loan. Mortgages could now move through a national financial system rather than remain inside the bank that originated them. This secondary market separated the act of making a mortgage from the act of funding it for its entire life. Over time, that structure became one of the defining features of American housing finance. Lenders originated loans. National institutions purchased or guaranteed them. Investors supplied capital through mortgage securities. Federal support helped keep money flowing into housing across regions and economic cycles. The new system was still developing when the Second World War interrupted civilian construction. Building materials and labor went to the war effort. New household formation did not stop. Millions of service members would soon return. Marriages and births were rising. By the end of the war, the country faced a sartage estimated at about 5 million homes. The next federal decision connected military service to private property. The Servicemen's Readjustment Act of 1944, known as the GI Bill, created a mortgage guarantee for eligible veterans. The Veterans Administration guaranteed part of a private loan, reducing the lender's risk. Congress soon improved the terms by increasing the guarantee and allowing mortgages to run as long as 25 years. For many veterans, the benefit reduced or eliminated the need for a large down payment. The monthly cost of buying a new house could compete with rent. A young family that might have spent years saving could enter ownership much earlier. This did not mean the GI Bill alone created the post-war ownership boom. The country emerged from the war with high employment, accumulated savings, expanding industry, pent-up demand, and a generation ready to form households. Researchers who have tried to isolate the effect of veterans' mortgage benefits estimate that they explain part of the increase, especially by helping younger men buy sooner. Broader changes in mortgage terms appear to explain a larger share. The federal contribution was therefore not one benefit or one law. It was a connected S1 stem. Mortgage insurance reduced lender risk. Veterans' guarantees expanded eligible demand. The secondary market replenished lenders. Federal standards shaped construction. Tax rules favored debt-financed ownership. Public investment in roads and infrastructure opened new land to development. Private builders learned how to use that system. In Levittown, Pennsylvania, farmland became more than 17,000 houses in only a few years. Crews repeated specialized tasks from one property to the next. Standard plans, bulk purchasing, prefabricated components, and rapid on-site construction lowered costs. Curved streets, schools, shopping facilities, pools, and landscaped yards offered not merely a house, but a complete version of middle-class life. Levittown eventually spread across nearly 6,000 acres. Within 5 years, its population exceeded 67,000. The development was privately built and profit-seeking. But its buyers relied on the long-term, low-interest financing that federal policy had helped create. This was the America after the transformation beginning to take shape. In 1940, fewer than 44% of American households owned their homes. By 1950, the rate had reached about 55%. By 1960, It had climbed above 60%. The change was especially important among younger families who could buy earlier and repay over a working lifetime. The expansion also changed the meaning of age and family formation. A younger household no longer needed to wait until middle age to accumulate an enormous down payment. Buying earlier meant beginning to build equity earlier. It also linked the new mortgage system to the baby boom, schools, consumer spending, and the geographic separation of home and work. This helps explain why the transformation became culturally self-reinforcing. Once ownership became common among peers, renting could appear less like one reasonable tenure choice and more like a delay in adulthood. Employers, advertisers, lenders, builders, and public officials repeated the same promise: a stable family should own a house. The policy had created a market, and the market created a social expectation. A house became more than shelter. Monthly payments built equity. Rising property values could increase family wealth. Ownership offered control over living space, access to particular schools and neighborhoods, and an asset that could be borrowed against, sold, or passed to children. The suburban house also became part of a larger economic machine. It created demand for appliances, furniture, automobiles, roads, utilities, construction materials, insurance, and retail. Local governments increasingly depended on property values and property taxes. School quality, municipal services, and household wealth became tied to place. Federal policy had helped make the mortgage a pathway into this system. But access was not equal, because the government's definition of safe investment included a definition of the safe neighborhood. The Federal Housing Administration's underwriting rules evaluated both the borrower and the property. Its 1938 manual explicitly included racial discrimination in the logic of mortgage risk. Agency practice favored new construction and neighborhoods believed to be stable, homogeneous, and protected from what officials considered adverse influences. Restrictive covenants and other barriers could be treated as safeguards for property value. The theory was presented as financial prudence. If racial integration was assumed to reduce prices, then a racially changing neighborhood appeared risky. If an agency denied insurance because the neighborhood was considered risky, credit became harder to obtain. If credit disappeared, property values and investment could fall. The system could then point to the decline as proof that the original judgment had been correct. This was not simply prejudice attached to an otherwise neutral mortgage system. It was a feedback loop in which discrimination shaped risk, and the official measurement of risk reinforced discrimination. Archival research has found that the Federal Housing Administration largely avoided insuring mortgages in low-income urban neighborhoods where most Black city residents lived. This exclusionary pattern appeared early and did not depend entirely on the homeowner's loan corporation maps. Federal housing policy did not invent every racial boundary, but it gave powerful financial support to some neighborhoods while withholding it from others. The consequences reached veterans as well. The GI Bill was written in race-neutral language. Black veterans had served in the same war and possessed legal eligibility for the same benefits. But the program operated through private lenders, local real estate markets, appraisers, developers, and state and local institutions. Eligibility did not guarantee access to a house, a willing bank, or an available neighborhood. A veteran could hold a federal entitlement and still encounter a lender who would not approve the mortgage, a developer who would not sell, a real estate agent who would not show the property, or a covenant intended to keep the community white. The Supreme Court weakened one part of that system in 1948. In Shelley versus Kramer, the court ruled that state courts could not enforce racially restrictive housing covenants. The covenants did not immediately disappear. Private discrimination continued, and developers could still decide whom they would sell to. But the legal machinery of the state could no longer be used to remove a family solely because a private covenant barred their race. The ruling did not integrate Levittown. By the 1950s, the suburb had become a national symbol of affordable mass ownership. It was also an ALW8 community. The houses stood as evidence of extraordinary productive capacity. Private builders, federal finance, standardized design, and a generation of buyers entering ownership. Then William and Daisy Myers purchased a home there through a private sale. William Myers was an engineer. He and Daisy had 3 young children. Their arrival did not threaten the physical structure of the house, the ability of their neighbors to pay their mortgages, or the quality of the streets and schools. Yet residents had been taught, through custom, policy, real estate practice, and official appraisal logic, to treat integration as a threat to property. About Essex 100 residents attended an early meeting opposing the family's arrival. Crowds later gathered near the house. Stones broke a window. Crosses were burned on the lawn. Cars displayed Confederate flags. The governor sent state police after local authorities failed to control the disturbance. The violence revealed what the language of property protection could conceal. A financial hestem had helped families acquire valuable homes, but many owners believed the value of that property depended on keeping other Americans outside. The reaction was not unanimous. Neighbors brought meals, offered friendship, and defended the family's right to live there. More than TWO 100 residents signed a statement of conscience. State authorities insisted that legal ownership carried the right to occupy the home. The Myers family remanded. Their story does not prove that every white homeowner received federal help or that every black family was denied it. Housing markets differed by region. Some black families obtained government-backed mortgages. Some white families remained renters or lived in poor housing. Federal programs expanded ownership across a broad population, and the barriers were never perfectly uniform. But one family's ordeal makes the larger structure visible. The most important question was not whether the federal government mailed a house to one group and refused one to another. It was whether public policy created different probabilities of access during the years when suburban land was cheap, homes were new, and decades of appreciation still lay ahead. That is where the long-term consequence begins. A family that bought a modest suburban home in the 1940s or 1950s did not merely receive a place to live. It gained entry to an asset whose value could rise for generations. Equity could help finance education, a business, retirement, medical expenses, or the next family home. Children could inherit property or receive financial assistance made possible by it. A family excluded from those neighborhoods did not simply miss one purchase. It could be confined to a market with fewer financing options, older housing, higher contract costs, weaker public investment, and less appreciation. The lost opportunity could compound across decades. In many cities, black buyers who could not obtain conventional mortgages turned to installment contracts. These arrangements could require high payments while withholding legal title until the final installment. A missed payment could lead to eviction and the loss of everything already paid. The buyer carried many of the costs of ownership without receiving its full legal protection. Meanwhile, federal urban policy often directed highways, clearance projects, and institutional expansion through neighborhoods that had already been denied mortgage investment. The geography of credit influenced the geography of demolition and redevelopment. This is why the story cannot end with the claim that federal mortgage policy simply raised the national homeownership rate. It changed the distribution of wealth, risk, and place. By the early 1960s, the contradiction had become difficult to defend. The federal government had spent decades organizing and supporting housing finance. Yet public money and federal guarantees could still operate through discriminatory markets. In 1962, President John F. Kennedy issued an executive order directing federal agencies to prevent discrimination in housing connected to federal assistance. The order was an important statement, but its reach was limited and enforcement developed slowly. The decisive national law came in 1968. After years of failed attempts, Congress passed the Fair Housing Act as part of the Civil Rights Act of 1968. The law prohibited discrimination in the sale, rental, and financing of housing on the basis of race, color, religion, and national origin. Later amendments expanded the protected categories. The act did not erase the earlier system. It made many discriminatory practices illegal. It gave the federal government new enforcement responsibilities. It allowed individuals to challenge exclusion. It addressed direct refusal, discriminatory financing, steering, blockbusting, and other methods of closing housing markets. This was a genuine transformation. A developer or lender could no longer openly present racial exclusion as an acceptable condition of ordinary business. The legal meaning of access had changed. The correction also produced another important change. Housing discrimination was no longer treated only as a private moral failure. It became a matter of federal civil rights enforcement. Complaints could be investigated. Patterns of discriminatory lending or sales could be challenged. Government agencies acquired a duty to examine whether supposedly neutral practices closed markets to protected groups. Enforcement remained difficult because discrimination rarely announced itself honestly. A family could be told that a house had just been sold, that no loan program was available, or that a different neighborhood would be a better fit. Detecting unequal treatment required records, testing, comparison, and sustained public authority. The legal rule had changed more quickly than many institutions and local practices. But LA Doe operates forward. Wealth accumulates through time. By 1968, the post-war housing boom had already transformed metropolitan America. Suburbs had been built. School districts and municipal boundaries had formed. Highways had opened land. Property had appreciated. Families had accumulated years of equity. The law could prohibit a future refusal, but it could not automatically recreate the purchase price, location, interest rate, or appreciation that an excluded family had lost. Nor did discrimination vanish when it became illegal. Federal enforcement cases continued to identify steering, false claims about availability, discriminatory lending, redlining, and exclusion through local land use decisions. The methods became less explicit, but the underlying incentives and geography remained powerful. At the same time, the federal housing system continued to expand and evolve. Fannie Mae and, later, Freddie Mac became central buyers and guarantors in the secondary mortgage market. Lenders could sell mortgages, recover funds, and originate more loans. Mortgage-backed securities connected household payments to investors across the country and around the world. The Veterans Administration continued guaranteeing loans. By August of 2025, the program had guaranteed its 29 millionth home loan. The Federal Housing Administration has insured tens of millions of mortgages since 1934. The federal government also continued to favor ownership through the tax code. Mortgage interest could be deducted by qualifying taxpayers who itemized. Gains on many sales of primary residences received favorable treatment. These policies reinforce the political and cultural position of the homeowner. Not every ownership subsidy has been equally effective. Research generally finds that the mortgage interest deduction does little to increase the national ownership rate because it does not directly solve the down payment barrier and disproportionately benefits higher-income households with larger mortgages. It may encourage spending on more expensive homes or become reflected in prices. That distinction matters. A policy can support homeowners without creating new homeowners. It can raise demand without increasing the number of houses. It can protect an asset after purchase without helping a renter cross the threshold into ownership. The most powerful earlier policies changed the threshold itself. They reduced down payments, lengthened repayment, standardized terms, and protected lenders from default. They changed who could qualify and when. The system also created new forms of national risk. When mortgages are standardized, purchased, pooled, and sold, credit can flow on an enormous scale. That scale can lower costs and stabilize lending. It can also spread losses far beyond the original bank and neighborhood when underwriting fails. The financial crisis of 2008 did not result from the New Deal mortgage system alone. Private subprime lending, weak underwriting, complex securities, inflated ratings, leverage, speculation, and regulatory failures all played major roles. But the crisis demonstrated how deeply the federal government had become embedded in housing finance. Fannie Mae and Freddie Mac entered federal conservatorship. Emergency policy again treated mortgage markets as a matter of national stability. The original transformation had become permanent. The United States no longer had a housing market in which the federal government intervened only occasionally. It had a housing finance system whose ordinary operation depended on federal insurance, guarantees, charters, regulation, tax rules, and crisis support. That system still produces extraordinary benefits. A long-term fixed-rate mortgage protects a borrower from future interest rate increases. Full amortization builds equity with each payment. Federal insurance and guarantees can expand credit to buyers with limited savings. A national secondary market can keep mortgage funds available across regions. Ownership can provide stability, autonomy, and a durable family asset. But the system also asks households to place much of their wealth in one leveraged property tied to one location. Maintenance, taxes, insurance, and price declines remain the owner's responsibility. Foreclosure can destroy equity. High prices can turn easier credit into larger debt. Communities with limited housing supply can convert public support into more expensive land rather than broader ACCSS, and the benefits remain uneven. In the first quarter of 2026, the national HOMEOWNER-SHIP rate was about 65%. The transformation from 1940 had endured, yet the racial gap remained substantial. In the Federal Reserve's 2022 Survey of Consumer Finances, about 73% of W-8 families owned their homes, compared with about 46% of black families. Among families that owned, the typical white family held about $205,000 in net housing wealth. The typical black homeowner held about $123,000. Those numbers do not come from one law, one map, or one generation. Income, inheritance, education, employment, local housing supply, credit scores, family structure, geography, and discrimination all influence ownership and wealth. But history shaped the starting positions. Federal policy made long-term mortgage credit abundant by changing risk for lenders. It helped millions of families buy earlier, build equity, and move into new communities. It turned home construction into a national growth industry and ownership into a central expectation of middle-class life. The same system also treated racial separation as a form of financial protection. It helped direct insured credit toward new, largely white suburbs, while many black families were confined to markets with fewer protections and less investment. Later, civil rights LA Doe changed the rules of access, but it could not fully redistribute the appreciation already accumulated. This is what the evidence establishes. America did not become a nation of homeowners because every family independently chose to buy and every bank independently chose to lend. The country built institutions that made ownership easier to finance, safer for lenders, and more valuable to households. The mortgage became a public-private instrument, privately signed, privately serviced, and deeply shaped by government. The house on Deep Green Lane stood inside that system. When William and Daisy Myers entered Levittown, they were not asking for a new principal. They had purchased property and expected the ordinary rights of ownership. The resistance they faced exposed the unequal boundary of the American housing promise. The neighbors who defended them, the state officials who protected them, and the laws that followed helped establish that ownership could not legally depend on race. But the deeper legacy remains visible in the map of metropolitan America, in the balance sheets of families, in the structure of the 30-year mortgage, and in the continuing expectation that a house should serve at once as shelter, security, retirement fund, inheritance, and proof of belonging. Federal policy did not make every American a homeowner. It made HOMEOWNER-SHIP one of the principal ways America distributes stability and wealth. And because the opportunity to enter that system was never equal, the country still lives with both sides of what it